Realty Income versus Agree Realty. So these are two very popular real estate investment trusts, or REITs. In my portfolio, I want some really good REITs. I want top quality, I want some good income, and I want some long-term capital appreciation. So today I'm going to put these two options head to head and see which is going to come out on top. I do have a small position in Realty Income that I'm looking to grow, probably depending on the outcome of this comparison. So watch through to the end of the video because I'm also going to uncover two of those key elements that I'll be monitoring really closely to ensure that my investments for my family stay safe in the long term. So let's get into it. Wonderful. So here I am in Fast Graphs. This is one of my favorite and very visual tools for understanding what is going on with a company. So we're on Realty Income Corporation and we're on a view here for the Adjusted Funds From Operation, or the AFFO. Now what this is showing us essentially is the orange line here is representing a 15 times price to AFFO. Now this is equivalent to the price to earnings ratio of 15 times for other types of companies. Now what this essentially is showing us here over the maximum period here of 20 years, we can see that the prices have bounced around and have generally followed this orange line upwards. There's been periods of overvaluation such as early 2020, as well as periods of much lower valuation such as here in 2009. Now, as we can see at the moment, we're here at the right edge of the chart. We have a price to AFFO at the moment of 14.38, giving us a dividend yield now of 5.34. Now clearly it would have been much better to enter here, and I did have some tranches that were purchased below $50, but not as much perhaps as I would have liked. So one of the questions, is it still a good time to buy? And the answer is, looking historically, the prices are still below this 15 times, and historically over the last 20 years there have been very few opportunities to buy at this level. Now Fast Graphs gives us a whole lot of information here which is also really useful. So we can see the market cap, as I said, a very large real estate investment trust. It has an A- S&P credit rating, which is fantastic. It has relatively manageable debt at 39% debt to capital. Now also as we scroll down, it has this analyst scorecard, and 100% of the time over 1 year and 2 years the company hits the analyst expectations and forecasts. Now what that means is the company is incredibly consistent. They provide good guidance to the analysts and operate in a very predictable and understandable way. And that is useful because it means that these forecasts here on the right hand side are actually forecasts that we can probably trust. They're probably going to be accurate forecasts. Now what does this mean? If we switch over to the forecasting calculator, and I'll switch this to the normal multiple, it's now going to plot over the multiple price to AFFO multiple that it has been over the last 5 years, which is 19 times. Now that represents what I would say is a premium. I think it's a reasonable premium. I'm not sure Realty Income will always be able to trade at this level in the future, but in the past they've done a pretty good job of having a multiple that is at a premium to 15 times. Now, a couple of key things I like to look at down here. We can see how the estimates have changed over the last 6 months, and we can see that there have been a couple of very minor changes, with the exception out here at the end of 2026 where there's only 2 analysts providing estimates anyway, and that has shown a little bit of a decrease. However, assume that prices will return to a 19.17 times price to AFFO ratio by the end of 2025, and we assume that these forecasts are fairly accurate, and we know they should be fairly accurate based on the historical ability for the company to hit the analyst estimates, then we could be looking at an annualized rate of return here of about 24% per annum, which I think is a very nice return. Now, why would the prices increase to that level? It's quite simple, really. If the Fed does begin to lower those rates, then it is highly likely that because the cost of borrowing for this company will decrease, they'll be able to make more acquisitions, grow faster, do better, spend less money paying down debt, and they're more likely to see that price rise. So Fed lowering the interest rates will be a very important catalyst here for the increase in price for this company. Now, 3-4%, it's not an amazing opportunity here. And what we can see as well, if we switch over to Fast Graphs Performance, is I like to look down here, the dividend growth column, and we can see that there's this very big bump here of 21% in 2013. But beyond that, 2, 3, 5, 4, 3, 1, 1, 7, 2. It's been somewhat inconsistent dividend growth, but I'd say 3%, maybe 4% dividend increases per year. Not the most compelling. It's a little bit lower than what I like to see, but I do like the stability, I do the certainty of Realty Income. Now, just simply here on compound growth rate, it almost matches the SPY since 2007. And if we flick here and switch on reinvesting dividends, then we'll actually see Realty Income actually would have outperformed the SPY over the last, since 2007. Now, if we look at Agree Realty in very much the same vein, we're starting off in the historical tab. We can see coming out of the global financial crisis, they had a couple of poor years. In about 2013, they started this nice, steady, slow growth. And we can see again that prices began to rise to a very high premium level, collapsed in COVID. They rose again to quite a premium level, and then they've dropped quite a bit down here as well. 2023 was the first time in 7 or 8 years really that you could buy this company at a reasonable multiple. Now, at the moment it's trading here above the blue line, which means it's trading a little bit lower than what it has over this last 5 years in terms of a price to AFFO multiple. It's trading at about almost 16 times, so reasonably high. Now, given the historic growth rate, the orange line here is at 15 times. It's only 14 times price to AFFO ratio. So it's not the absolute ideal time to buy, but it does look again as though there is some fairly good projected AFFO growth in the future. Now, it's important to note here as well that they have missed the analyst estimates 1 and 2 years out a couple of times. Not too shabby, and we can see that the dividend yield is also a little bit lower. But the company itself represents a much smaller REIT. It is rated by S&P, but only with a BBB credit rating. But we also see a more manageable debt to capital ratio here of 30%. Now, if we flick through to the forecasting calculators, in much the same way we can see some good stability here in the estimates for AFFO. Relatively stable, slight decreases over the last 6 months. But if we project through to the historic price to AFFO ratio that they've had over the last 5 years, and we assume prices reach that point, and we assume that this estimate of AFFO is accurate, then we're looking at a total annualized rate of return of about 20%. Now, on top of this 4.7 dividend yield, what sort of growth rate are we expecting to see? So again, if we turn to the performance tab, we can look down here, and in the last 10 years, we've sort of seen 6, 4, 5, 6, 5, 5, 8, 7% dividend increases each year. So I'm picking probably about a 5% yield now, with likely to be about 5% dividend increases moving forward. Now, since 2007, as we know, it had that poor performance up until about 2013, so I wouldn't expect it to be hitting at the same level as the S&P 500, but if we look at the same calculations with dividends reinvested, it is pretty much bang on or on par with the S&P 500 performance. Realty Income is big. There is no getting around this. Now, as they become bigger, it does confer some advantages. They're able to borrow it, and they also have a fantastic looking debt maturity schedule with no substantial debt repayments due soon. Now, these are all some really positive points for Realty Income, but as they become bigger, it becomes harder and harder for them to grow. It becomes more difficult for them to acquire properties in a way that is going to shift the needle, in a way that's really going to increase the adjusted funds from operation per share. Now, yes, they can do acquisitions like Spirit Realty, which has recently been discussed, and this is the important way that they are able to drive growth going forward, is through acquisition. Now, the management team has a fantastic track record of accretive acquisitions, where they're able to buy and acquire resources from other REITs and use those to grow their own portfolio. Now, this is really important because the company itself tends to only have a 1% per annum accelerator in the rent agreements with their clients. Now, this means that they're not able to rely on those rent payments going up on a regular basis in order to drive really powerful FFO growth. So they need to find that growth from somewhere else. So, Realty Income is big, it is massive. What about Agree Realty? Well, it's smaller, it's more nimble. And while Realty Income has branched out, looking at acquisitions as, casino, gaming facilities, big acquisitions such as Spirit, Agree Realty has been very, very focused on their core business. Now, in both cases, the core business is more or less recession-proof organisations, and yes, there are some tenants such as Walgreens, which has just announced a massive dividend, which are otherwise struggling a little bit financially, but it should not affect either Agree Realty or Realty Income. Both these companies, there's no real moat here. It's fairly easy because of the size and the scale of these facilities. They're relatively small, freestanding properties. It's relatively easy for another real estate company or a developer to come in and to create and develop real estate in competition with these REITs. So I would not say that there is any particular moat or competitive advantage that these companies. Realty Income, I might argue, has a little bit of an advantage from their size, equity, access to equity raising, capital raising, to borrow through their European operations at lower interest rates than in America. Perhaps they have the benefit of greater diversification geographically than Agree, but it's not a substantial economic moat or competitive advantage in my mind. So I'd say both of these companies have relatively small. What then is a big difference? Well, in my mind, what we've seen in the last several years is debt does. As Realty Income does have, is this by itself a bad? No. But it is important to note that from about 2026 to 2028, they do have some fairly reasonably sized debt maturities coming up for each one of those 3 years. Now that represents a fair amount of funding that has to be diverted to repaying that debt or refinancing those debts, probably at higher interest. Now in contrast, Agree Realty only has a handful of debt maturities on the horizon in about 2028, 2030, 2032 and 2033. Each one of those is relatively small. They're all consistent sizes and they're quite spread out into the early 2030s. Now, you put that together, in my mind, Agree Realty basically has to win out there when we begin to think, what am I? I have to be honest, I'm making the biggest investments into Realty Income early, when it was at a much more favourable price to AFFO. I'm not entirely happy with the price now, but I have been building up my position a little bit further. It's almost at the larger position size in my portfolio that I'm looking at, but I'll be adding a little bit more there. However, the slightly faster dividend growth rate of Agree Realty, I think their strong debt positioning, they're very laser focused, their market, their type of properties that they are willing to invest in. These are all very attractive, and so I'm also just starting a position with them. Which of these two companies represents the best fit in your portfolio? Is one of these an interesting option to add to your portfolio, or are they both options that you would avoid? And let me know in the comment section down below, and I'll see you in the next video.